Hi, this is Mike Flores here, co-founder of Trade Prosper, and welcome to Section 4, Video 3, How to Keep More of Those Juicy Moving Average Profits. Now, so far, I've given you two methods to use moving averages with, the crossover and the crossover of price versus the moving average. And these allow you to catch big chunks of the market's move. But now let's talk about when and if you should take some of those profits. You see, we want to really capture as much of the move as we can, and we never really know when the market is going to stop giving us profits when we catch one of these big rides, as we see here on this chart. Now, this is a chart of the New Zealand dollar versus the US dollar. In the previous videos, we've talked about using the 200-day simple moving average. So price crossed the 200-day simple moving average on this day, and we could use our stop as the line for this example. And we notice here that the price never went below the line. Even if you would have used the low of the day, you would have been stopped out here but would have got back long the next day. So either way, you'd still be in the market. All right, and if you use support, you would use these levels down here as support, so you definitely would still be in the market. So, okay, we're in the market, we're long. Now the market has a really good move and it starts breaking higher, and we can see that. Now we see though that it breaks from all the way down where we get long at 0.5937, right? The close of that day is 0.5937, so we bought market on close on that day, and the market got all the way up to 0.7635, that high on that day. And then we notice we would have gotten stopped out down here at 0.6873. So how do we go from not giving up all of those profits, giving back this chunk on this move down? Well, let me show you a quick way that I've devised to do this. Now, I've done this because of my observation over the years watching these markets and noticing something over and over again. Now, remember, we don't want to be too fast with taking profits. Like the famous trader Michael Marcus said, if you don't stay with your winners, you're not going to be able to pay for your losers. Now, letting your profits run, it's not very easily psychologically, but if you try and protect every single penny of profit, you'll inevitably cut yourself out of the big profits, and we want to ride the move to capture the big profits. So now let's talk about the actual technique that we're going to use. So when the price of the market you are in is 15% above or 15% below the 200 or the 50-day moving average, exit at least half the position. Even you can exit the whole position. So what does that mean? So when the price trades and closes back below 15% from the movement of the line, you would get out. So in this case, we're long. So when price goes 15% higher than the moving average, you're going to exit at least half your position or your whole position. Now, why 15%? I use that rule. I use that as the barometer, 15%, because rarely do you see a market move and sustain a move greater than 15% from the 200-day moving average for an extended period of time. Now, I think 15% is a good number to at least take half of your profits, because I warn you, there will be times where the price goes from 15% to higher, sometimes 20%, 25% above the line, maybe even more than that. So let's look at the example here. At one point, this New Zealand dollar versus US dollar market is 23% above the 200-day moving average. Now, how can I see the percentages? Well, remember I told you guys before I like to use Pro Realtime as my charting platform. So let me show you how I do that. In Pro Realtime, there is a function that allows you to choose line by percentage. Line by percentage. So what you would do is you would start from the moving average line, click on it, and then ride to the top of the bar that you wanted to look at. So I let it go, and then you see 14.06%. So on this day, price was 14.06% above the 200-day moving average line. Then I look at another day, and I say, okay, this day was a really high day. So let's see what happened, how far above it we were this day. Okay, that day we were 18.69% above it. That's a lot, isn't it? So now, what I'm doing is I'm doing a spot check. I don't have a way to cleanly find everything. But what I'm doing is I'm looking for, this day was 15.45% higher. Here goes another high. That one's 21.3% above it. So you see I click over the green bar. I click on the pink line, so I'm over the green bar above, and I'm also on the pink line, and then I just go straight up to the top of the bar. And this one's 23.86% above. So, using this as an example, how could we have played this? Well, we got long all the way back here. This was 14%, so I probably wouldn't have done anything. Then here goes the next really significant high here. This is 18.69%. So what I could have done here was either exited part of my position or all of my position. Now again, this is something you have to play by ear. I can't tell you that every single time you should exit everything at 15%, because sometimes that works and sometimes it doesn't. 15% is a barometer. You can use whatever barometer you like. You can use 20%. I prefer 15%. I have a buddy who uses 10%. He's happy to make 10% on any position. But 15% I find is the best threshold that I've seen overall. So here on this day, I look and say the next day that the market closes below 15%, I'm going to get out of half or all of the position. Okay, and then what I do is, then from every day after this, I'll just check the market. I literally just go there. I click above. That says 16.25%, so I don't get out. This one is the closest one at 15.45, but I probably wouldn't have got out here either. I just kept it going. Now at 21.3% and 22% and 23%, we're really getting stretched. So what you could do is every percentage that it goes above 15%, you take a piece of the position off. So let's say it goes 16%, you take a piece of the position off. 17%, you take a piece off. 18%, 19%, until you've liquidated all of your position. Now again, there's no perfect way to capture the whole move, but this is a good way to help you from giving back from 23% all the way back to the line here. You gave back a bunch on this move up to this move down. All right, so that's a good way for you to figure out by using percentages to help you say, okay, the market's really stretched very far above the line. Let me take some profit here. Now, I really only use this technique when I'm doing price crossing the moving average lines, which is what I showed you in the last two videos of this section. So I hope that helps you realize how you can take profits and keep more of the profits rather than having to give some back on a big move down like this. All right, I'll see you guys in the next video. Talk to you soon. Mike Flores.